Okay, let's dive in. Today, we are really cracking open something pretty advanced. It's a proprietary financial analysis, all about spotting the big players, the institutions, buying when everyone else is panicking. That's right, we're digging deep into this strategy called structural accumulation, or maybe the more catchy name for it, faith over fear investing.
Wow. Yeah. Faith over fear. I like that. And we're using some very specific source material here.
We are. We're drawing straight from documents authored by Devin McClarty, who founded Structural Intelligence, and it's all managed under the financial engine that's the analytical core for D Investment Enterprise LLC.
Okay. Specifically, we've got the accumulation strategy, CONY and MRNY structural insight. And honestly, it's probably the clearest look we've seen at how, smart money views major market weakness. They don't see a threat. They see a chance to buy.
Right. So our goal today, our mission, if you like, is to really break this down for you. Take this pretty complex quantitative system and pull out the nuts and bolts.
Yeah, make it digestible.
Hmm.
Because fundamentally, it's about turning that scary market volatility into a structured strategic plan.
It really seems keyed into recognizing a very specific behavioral pattern in the market. So what actually defines this faith over fear dynamic? Let's start there.
Well, at its heart, it's purely behavioral, but it's measured mathematically. It's not just a feeling.
Yeah.
The fear part, that's your widespread emotional selling, capitulation, panic driving prices down hard.
Okay, the big sell-off.
Exactly. That creates the discount.
Hmm.
Then the faith part kicks in. That's the systematic buying, the absorption of all that cheap volume by institutional players. These are buyers who are confident in the asset's actual underlying value long term, and they're completely ignoring the short-term noise.
So it's kind of like that old saying, right? Buy when there's blood in the streets. But quantified, precisely. But, and this is crucial, the analysis is really strict about this. You can't just feel the fear or guess that smart money is buying. You need proof. Cold, hard, measurable proof that both things are happening at the same time. Okay, so there are specific signals, non-negotiable ones, it sounds like.
Two mandatory signals, yes. The framework demands that for this structural accumulation to be real, you need to confirm both the selling environment and the buying intent simultaneously. All right, let's break those down. Signal number one, the fear signal. How do we know sellers are actually capitulating, giving up? It's a technical rule. Simple but specific. You need a clear sign sellers are throwing in the towel. And the threshold is a price drop of -5% or more over just a 7-day period.
-5% in 7 days.
Okay. The documents call it the 7-day delta, symbolizes about. If 7-day HOIS is less than or equal to -5%, that sharp, quick drop confirms the kind of emotional selling environment you need.
That makes sense. A steep drop definitely signals panic. But, like you said, lots of analysis stops there. A price drop alone could just be the start of something worse, right? A real collapse.
Exactly.
So how does this McClarty framework confirm the really critical part, the faith? How do we know that smart money is actually stepping in and absorbing that sell-off?
That's where the proprietary metric comes in. It's called the Divergence Euroscore. This is really the engine of the whole strategy.
Divergence here.
Conceptually, what it's doing is measuring the strength, the magnitude of institutional money flowing in relative to the price action and the volatility. So when the price is tanking, that's high fear, but this score is high, it tells you that big concentrated buyers are moving against the crowd with real conviction.
Okay, hold on. If Divergence Euros is proprietary, how can how can you listening at home sort of wrap your head around what a high score actually means? Is there an analogy?
Yeah, that's a good question. Think of it maybe like this. Imagine a big ship caught in a sudden huge storm wave. That's your -5% price drop.
Okay.
Most people on deck are panicking, right? Throwing stuff overboard that's like the retail selling. The Divergence Hitter score, that measures this incredibly powerful, quiet engine deep below deck that suddenly kicks into overdrive.
Oh, okay.
It keeps the ship steady, maintaining direction and power despite the chaos on the surface. So a high Divergence Hero score means that hidden engine, the institutional demand, is way stronger than all the surface noise and panic.
That's a great analogy, really clear. So what's the magic number? What's the threshold for that engine kicking in according to the strategy?
To confirm the faith signal is active, the Divergence Euroscore must be greater than +1.0, +1.0.
Greater than +1.
Yep. So when you get both conditions met, the steep 7-day price drop, -5%, and this Divergence Euro score popping above +1.0, that's when the asset officially enters what they call the faith over fear zone.
Got it. The volatility has basically been transformed structurally into a specific buying opportunity.
That's the idea. Okay, let's make this real. Because the source material you mentioned gives us actual data, verified on November 11th, 2025, for two specific low liquidity ETFs, CONY and MRNY. They have this specific accumulation card. So what did the data show for the fear side? Well, both of them definitely hit the fear threshold. CONY 7-day delta was minus 6.60%. That's a pretty big overreaction,
Yeah,
clearly.
significant.
And MRNY wasn't far behind. It was also in a kind of free fall, clocking a 7-day delta of minus 5.59%. So for both CONY and MRNY, the right environment, the fear environment, was absolutely confirmed.
Okay, fear confirmed for both. Now for the crucial bit, the structural insight. What about the institutional conviction? How did that divergence score compare between CONY and MRNY?
All right, so both confirmed accumulation was happening. The score was above plus 1.0 for both. But there was a really interesting difference in, let's say, the aggression of the buying.
Okay.
CONY posted a divergence year score of plus 1.10. So it just cleared that mandatory plus 1.0 hurdle.
Just over the line.
Exactly.
Yeah.
MRNY, though, came in much stronger. Its divergence zeros was plus 1.50.
Wow, okay. 1.50 versus 1.10. That's quite a difference. And their prices at the time.
Yeah, the live prices were CONY at $5.66 and MRNY way down at $1.52. So clearly, smart money was seeing value in targeting those specific discounts.
So that difference, the plus 1.10 for CONY versus the much higher plus 1.50 for MRNY, that's telling a deeper story, isn't it? It suggests different levels of, well, faith.
It really does. You could think of the plus 1.10 for CONY as maybe the institutional buyers cautiously testing the waters, confirming the discount looks good, but maybe holding back a bit. The plus 150 for MRY, that's like the institutional buyer walking right up to the edge of the pool and doing a cannonball. It signals that the accumulation in MRNY was happening with significantly more conviction, more aggression relative to its price drop compared to CONY. It could mean they see potentially higher returns there, or maybe there's just a stronger consensus among those big buyers about its value.
And the documents also mention something called a behavioral flow gradient, analyzing the broader mood, faith, fear, and dependence. How did that fit in?
Yeah, that seems to back up the stability idea. During that period, the analysis showed faith was high, meaning that concentrated buying conviction was strong enough to absorb the selling pressure.
Okay.
And importantly, dependence was low. Now, dependence here refers to reliance on trend following or general retail sentiment for stability.
Right, the herd mentality.
Exactly. So low dependence means those panicked retail sellers were basically being swapped out, replaced by these systematic, powerful institutional buyers. And that whole process leads to what they call a flattened gradient shape. It signals the emotional panic has kind of burned itself out, setting the stage for potential stability.
Okay, this is where it gets really interesting for me. So the structural accumulation is confirmed. The faith beat the fear. The signals are there. What's the next step? What's the forward-looking strategy that comes out of this analysis? I mean, what does this all mean for you if you're trying to use this insight?
Well, the strategy outlined is pretty clear, and it's phased. First, there's the tactical outlook. That's the very near term, like the next 1 to 3 days.
Okay, short term.
Because those structural inflows, that heavy buying, have basically put in a strong price floor. The analysis suggests stability is the most likely outcome. So you'd expect either basing where the price just kind of consolidates sideways, testing that new floor, or maybe a minor climb, just a gentle rise as that continued buying pressure naturally starts to nudge the price upwards.
Okay, that makes sense for the immediate aftermath, but how do you know if this institutional faith is actually going to stick? How does it turn into a more durable trend? What's the confirmation look like for, say, the next 1 to 3 weeks?
Yeah, for that longer-term confirmation, the strategy says you need to watch for a follow-up signal. Specifically, a positive DDI alignment.
DTI.
Stands for directional index. It's another proprietary metric within the financial engine framework. Essentially, it confirms that there's sustained positive directional strength building up.
So conceptually,
Getting that positive DDI alignment confirms faith strengthening. It's like the market is starting to wake up and notice that institutional floor. The conviction is translating into actual positive price momentum. It suggests the early bargain hunters, the faith buyers, are now being joined by others, maybe momentum players.
got it. Okay, now the crucial flip side, risk. If this whole strategy hinges on these signals, especially the proprietary divergence zero, what happens if the institutions change their minds? What's the exit plan? How do you protect your capital? Risk management is absolutely fundamental here. It's not optional. It's built in. And it's basically two-pronged. First, you've got your standard technical safety net. The analysis is very specific. Place your stop-loss orders 1 ATR below today's low.
Okay, ATR. For listeners maybe not deep into technicals, can you just quickly unpack what ATR, average true range, means?
Sure, sure. ATR is a pretty standard tool. It just measures the typical trading range or the volatility of an asset over a recent period, usually 14 days.
Okay.
So by setting your stop loss 1 ATR measure below the most recent low price, you're essentially building in a buffer based on the asset's normal recent noise level. You're saying, look, I'll only get out if the price breaks down significantly more than its usual daily wriggle. It confirms a real breakdown, not just random fluctuation. It helps take the emotion out of deciding when to cut losses. Right, using data to define the failure point. Smart. But it sounds like the real core risk check comes back to that proprietary score itself. What's the absolute red flag?
Yes, the most critical piece is continuously monitoring that divergence or metric.
Yeah.
You have to make sure that score stays at or above that plus 1.0 threshold.
At or above plus 1.0.
If that number drops below plus 1.0,
Yeah.
that is the ultimate red flag in this system. It signifies that the structural conviction, the institutional faith that defined the whole opportunity has evaporated. That engine we talked about, it just stalled.
Huh.
The structural floor that made it a faith over fear zone is gone. And if that happens, the framework says it's time to exit the trade, period. Doesn't matter what the price is doing at that exact moment. The core reason for being in it is no longer valid.
Okay, wow. So the entry and the primary exit signal are both tied directly to that core faith metric.
Exactly. So I think the core lesson, the takeaway from digging into this D Investment Enterprise methodology is really clear. Structural accumulation isn't about trying to guess the market bottom. It's a quantitative process. It's about recognizing when that chaotic volatility has actually been turned into a very specific strategic opportunity, confirmed by those two precise data, signals the fear and the faith.
And crucially,
And crucially, you always have to pair that measured opportunity with an equally defined risk plan. A plan where the failure of that core faith metric, the divergence score dropping, is your ultimate signal to get out.
it really does bring it all back to, well, human behavior, but measured by machines, doesn't it?
Hmm.
There's actually a quote in the documents, a sort of foundational principle from the financial engine itself that kind of sums up these forces perfectly.
Oh, yeah.
Gold measures fear. The dinar measures faith. The dollar measures dependence.
Fear, faith, dependence. Interesting framework.
It is, and it makes you think. This entire system, developed by people like Devin McLarty, it's built on quantifying belief, right? Fear, faith, dependence, these very human emotions and states, using technical scores like divergence users to predict market structure and movement.
Yeah, when you put it like that. So if these incredibly complex financial systems are genuinely getting good at measuring something as intangible as human conviction, well, it leaves you with a kind of provocative thought to chew on. What are the real limits here? How far can we go in quantifying human sentiment? And maybe even more interestingly, what other systems, financial or not, are we maybe inadvertently using every single day that are actually measuring our deepest beliefs and emotions without us even realizing it? That's definitely something to think about.
We'll leave you with that thought for today.